great job on my last name, because it's not an easy one. As you can see, it's kind of small letters, but it's two last names in one, Lopez and Pineda. I usually tell my clients, I'll give you a quarter if you can say my last name. It's kind of tough. But anyways, thank you for having me here. I am very excited to be here because I'm actually talking about an asset class that I think is one of the hottest things happening today. Guess what it is? Bonds. Exactly. Who would have thought, after all this time, bonds are back in, and they're one of the hottest asset classes out there, delivering on what our clients want. That diversification, liquidity, performance, all those aspects. Anyways, you already met me, that's my name. I have my last name. And I work for Foyston, Gordon & Payne, who's the investment manager for your bond fund. Like I said, Foyston, Gordon & Payne is an investment manager. It sounds like a law firm, but we're not. We've been around for 43 years, manage over about $7 billion for clients like you here. And like I said, I'm very excited because I'm going to be talking about why bonds are back. Exactly now. We've gone through 20 years, not longer, actually longer, 40 years of declining interest rates, really. But now, we're here at this point in time, an inflected time, where, once again, bonds are the diversifier that you're looking for in your portfolio. This little chart here, what it does is it just shows you how yields have actually risen over the past 2-3 years. We've gone from pretty much, the gray area here is the COVID period, where we were almost at zero in yield. But now we peaked in October of last year at almost 5%. So bonds, again, are providing you what you want in your balanced portfolio, let's say. Higher yield, diversification. So now you're getting exposure to a lower correlated asset class. And also, you're getting exposure to assets that are liquid. And liquid is an important aspect in the bond space. Because with liquidity, we can actually take advantage of different market conditions. This is an example of preferred shares. Preferred shares, we like preferred shares because they provide a significant yield advantage over bonds. But the interesting part about preferred shares and being able to be liquid and take advantage of market dislocations is that this preferred share here actually reset at a significantly higher yield after its 5-year timeline. So preferred shares reset every 5 years. There's a segment of the market that does this. And in Canada, it's a majority of the market. And here you can see the advantage of being able to invest in different type of bond securities, preferred shares here, at 31% advantage, just by resetting. What's happening? Well, we're resetting at significantly higher yields now. I showed you that chart earlier, right? When all these bonds were issued, yields were really low. But now that they're resetting these preferred shares, they're resetting significantly higher. So we like that liquidity aspect, because we are able to take that advantage in the marketplace. We also like GICs as well, but for us, we like upside. So in this little chart that I put together, I know for a while a lot of investors are going into GICs because of the guaranteed aspect, because of the no downside aspect. But when I looked at the history over the past 24 years here, you can see that by having liquidity, by being able to take advantage of market dislocations, an active bond fund can actually outperform your GIC, which you can see here. Yes, a GIC will give you that protection, but what active bond management gives you is upside. And that's what you see in those blue bars here on the screen. The beige bars are the GIC returns every year, the 1-year GIC, while the blue bar is the Universe Bond Index for that 1 year. So you can see how significant of an upside you can have within your bond portfolio by actively managing it, maintaining that liquidity, and taking advantage of those dislocations. So we talked a little bit about the bond space. Why don't we talk a little bit about the fund itself? That's the second exciting part of why I'm here. That second exciting part of my whole presentation, I would say. we actually became your investment manager back in 2011 for the bond fund. So this chart here shows you how a $100 investment has performed against the average of your peers. So the blue mountain chart here is actually the Tradex bond fund that we managed in 2011. The green that you see here is the Canadian fixed income, the average Canadian fixed income mutual fund return. So you can see here over the past 13 years, we've been able to significantly outperform the average of those mutual funds in the industry here. And how have we been able to do that? Well, we built a solution for you that actually is diversified. It gives you exposure to different asset classes as well. So here you can see that we have exposure to, within the bond space, we have exposure to credit, corporate bonds. Yes, we also have exposure to government bonds. We have exposure to preferred shares, which are non-correlated to the bond market and give you that significant yield advantage. And we also have exposure to dividend-paying equities as well. So we built a solution that is diversified, so as the market shifts, we're able to provide you with the performance that you're expecting, as well as the yield that you want for your portfolio. Here's the yield of each of the sub-asset classes that I just mentioned that make up your portfolio. From, you can see I'm getting older, I'm taking my glasses off and on. Read short distance. We have government of Canada bonds on the left-hand side yielding 4%. We have corporate bonds yielding 5%. We have preferred shares at 6.2%. And then dividend equity at 4.3%. For an overall yield of your portfolio of 4.7%. So that's what you're getting within your bond portfolio. But not just that, as I mentioned, we built this diversified portfolio to also give you that performance that you're looking for. That mountain chart that I showed you before, here it is. Here it is. Blue bar is the Tradex bond fund. The yellow bar is the index, the Universe Bond Index that we compare against. And then the green bar is the average of our peers within the bond market and the bond mutual fund space. And here we can see how our strategy over the short term, so we'll start off with 3 months. So this is as of March 31st. You can see how the last 3 months, how our portfolio has performed against our peers. While our peers are delivering a return of negative 1.1% in the green bar on the left, we've actually delivered 1.9%. That's a 3% advantage that we've been able to do for you, the unit holders of the Tradex bond fund. And that story actually continues along every period that you see here, from the 3 months to the 1 year, the 3 year, the 5 year, and the 10 year. Our strategy continues to be successful, not just over the short term, but over the long term. As I mentioned, we managed this fund for 13 years now. But we've been able to successfully do this through its history, outperforming the 1 year number, outperforming by more than double what the index returned. Same story for the 3 year, 5 year, and 10 year. Now I always get asked, well, Gabe, that's great performance, but where are you getting your performance from? I mentioned we built a diversified portfolio that gives you access to different asset classes. Well, here's the actual breakdown of the portfolio. These figures here are gross returns. But what I've done here is I wanted to show you how the portfolio is outperformed on the left-hand side, the total portfolio itself. But on the right-hand side, you can see how each of the sub-asset classes have been able to add value through different periods of time. I just mentioned the 3 months, the index was negative. So if you look at the top right-hand side where it says bonds, yes, the bond index was negative actually for the first quarter of the year. It was down 1.2%. Our bond strategy was able to outperform the index, returning just negative 1%. But with the addition of the other lower correlated asset classes, like preferred shares, like dividend equities, a small piece of that was able to actually deliver positive returns, so positive absolute performance within your portfolio. And that's a number that you see on the left-hand side. And what I'm very happy about is we've been able to successfully do this across every period that you see here. So if we start looking at the 1 year figure, again, the total portfolio is on the left, but on the right-hand side, you can see how every single asset class that we implemented the selection of the securities, the bonds that we put into your portfolio have been able to outperform during that period. And that story continues along within the 3-year. And of course, my favorite one is since inception. Why? Because this shows you that over that 13-year history that we manage your portfolio, we've delivered 4.5% return every single year. That's what since inception means. I always like to explain that to my clients because we always focus on the short term. So when I tell them, well, since inception means that for the past 13 years, every single year my portfolio has returned on average 4.5%, beating up the benchmark return of 2.7%. And we're very proud of that. At Foyston, I'm very proud to have you guys as our clients to show you this. To close off the presentation here, stay within like 20 minutes. Just want a couple of comments on where the market is heading. And I have a crystal ball, but it doesn't always tell me the right thing. But the bond market has been volatile. You saw the interest rate chart at the beginning. We went from 25, 50 basis points to 5% now on the overnight rate. So the bond market continues to be volatile. Geopolitical aspects, recession fears, that's all we hear about on the news. They're playing a bit of havoc in bond yields. Right? The recession from 2022, we're still waiting for it. Right? But we prepared our portfolio for those kind of aspects. So inflation, recession, geopolitics continue to drive yield up and down. We saw that in the fourth quarter of last year. We saw it again in the first quarter of this year. And I think what's important for us is active management, liquidity, and diversification, we believe, are the ways to drive performance, just like we've driven that outperformance for the past 13 years. And we'll continue to do that for the Tradex portfolio over the next while. I think we're taking questions at the end, I believe, or is it?
Questions now.
I can take questions now, even better. Please go ahead.
Just to think about the future somewhat in 2024, 2025, I mean, obviously if you have a bond fund and if interest rates were to go down significantly, then the price of bonds are going to be going up, and other interest sensitive holdings you have. That would be something as someone who has a little bit invested in your fund and look forward to. I mean, it's going to happen someday, right? I mean,
Yes.
What are your thoughts?
Yeah, what are my thoughts on interest rates going down?
Yeah.
Yeah, so our expectation as a firm is that the market has been quite aggressive at rate cuts. We think inflation is going to be here for a bit longer.
Mm-hmm.
And because of that, it's going to take longer to see rate cuts. So our expectation really is for us to see a rate cut in Canada later this year. So the second half of this year is our expectation to see a rate cut.
Mm-hmm.
I think the market is a rate cut, not a significant one. No, we don't think it. I don't think we're gonna be in the world of 50 basis points like we were during the COVID period. We think rates will come down over time, but what we saw during COVID was an anomaly.
Yeah.
So, but I think the other point to mention is performance doesn't only come from rates going down, right? In your bond portfolio, that's what the yield number is for.
Mm-hmm.
So even though perhaps you're not getting the performance, you're getting 4.7% return. Pretty much, not guaranteed, but it's pretty much guaranteed that over the next 12 months, you'll be getting 4.7% return just because of that yield aspect. That's where the difference comes in. We've gone through 40 years of rates going down, bond portfolios going up in value, but there hasn't been any yield in there. You have to take that into consideration as well. Any other questions? It's going to be tons because it is, like I said, the hottest asset class in bonds. I know you're holding it all out till the end of the meeting. Well, thank you for having me here. And I'll be here with you.
Thank you very much, Gabe. And if anyone has any questions or thinks of any further questions, Gabe will be here at the end of the I'd now like to introduce Michael Edmonds from the City of London Investment Management Company Limited. Michael is our lead portfolio manager based in Philadelphia of the Global Equity Fund. Michael, we'll turn it over to you.
Good evening, everybody. It's great to be back here at the RA Centre after a year off. It's 25 years since the launch of the Tradex Global Equity Fund this year, and we've actually redesigned our presentations, and I think that's probably a little bit longer than 25 years. So, but Blair said that we should have some lasers. I can't apologise for the London architects, but this is the Gherkin building in London, so you'll see it in a lot of movies. So, 25 years of Tradex Global Equity Fund. This is the most important slide in the entire presentation. And what it shows is the yellow line is the return of the fund, the blue line is the return of the benchmark, and the red line is the average Canadian global equity fund. But that's, the ratio of the lines isn't really the point. The point is that you will see that the performance goes up and to the right. And Charlie Munger, who worked with Warren Buffett and passed away this year, one of his famous quotes was, "The first rule of compounding is to not interrupt it." That means let it happen, stay in the market. It's not about, you see all of these throughout this 25-year period. We've had the tech bubble bursting, we've had the GFC, we've had Euro crisis, Brexit vote, COVID pandemic, inflation scares. And one thing I can guarantee you is there will be other events like this where markets go down a lot. But the point is, it's not about timing the market, it's time in the market. So it's stay invested, ride out the volatility, and you'll generate the compounding returns that will really build wealth over time. So with that slide out of the way, if you want to check hockey scores, go ahead. Tradex Global Equity Fund, what do? We invest in closed-end funds, which are a type of fund that trade on stock exchanges. They have an underlying net worth, but the price at which they trade may be at a discount or premium to the underlying net worth, which is the net asset value. So these discounts and premiums vary over time, and what we are trying to do is take advantage of when the funds within our universe are trading at wide levels of discount and capture that outperformance from the discount volatility. Effectively, what we're doing is what we all do when we go to the store. We try to buy the cheap stuff, and we avoid buying things which are not on sale or which are expensive. It's very much a value-oriented strategy and very diversified in terms of underlying exposure. How do we do this? Two main things. We meet with all of these closed-end funds. We meet with the managers. We understand how they're investing, what their investment style is. We understand what their long-term performance is, but also their short-term performance, because that can be an opportunity. We understand the feature of the closed-end fund and where it's trading from a discount perspective. And we also talk to them about ESG factors and how they incorporate that into their portfolios. Then we look at our overall universe and we construct a portfolio providing diversified country, sector, and investment style exposure that over time should provide good long-term results. That's effectively the strategy, and there's really three components: returns, there's our country allocation versus the benchmark, the NAV performance of the underlying funds, so how a Japanese fund does against the Japanese market, for example, and then it's the discount movements. And so we want all of those components to be in the green over time, generating outperformance. So going to the markets over the last year, it was a very strong year for markets overall, up 25%. So from an absolute return point of view, a great year for investors in global markets. From a sector point of view, IT was the best performing sector. This was a lot of the large technology companies, and we'll come on to them. Communication services also used to be just telecom companies, but now is things like Alphabet, Meta, which used to be called Facebook, and Netflix and things like that. So those are much more growth-oriented, and so that sector did particularly well as well. The sectors which didn't do so well are some of the more interest rate sensitive sectors and also defensive sectors such as consumer staples. In terms of markets, and I feel like I've been saying this for many, many years, but the US was the best performing market, and that was driven primarily by the performance of the technology companies. The Japanese market also did quite well, returning 25%, and actually the Japanese market recently exceeded its high of over 40 years ago, so it's been a long way back, but Japan is doing a bit better. Europe, Canada, Australia, less well. The UK was a laggard, and then emerging markets also lagged, and that was primarily China, which was about flat, and but some of the other markets did quite well. So this slide, this colourful slide, is effectively showing the investment styles of the portfolio. So on the left-hand side, this is looking through to the individual holdings. So one of the things I said at the beginning is a very diversified exposure, and you can see we have exposure to a lot of different investment styles. We are biased towards growth-oriented styles, and that's partly because those have been some of the laggards, particularly in the small and mid-cap space over the last couple of years. We do have the most exposure in large cap growth, which if you look on the box on the right-hand side, these are the returns from those different investment styles. So you can see that the large cap growth style was the strongest, returning over 33%. What is also noticeable is that whereas large caps did well, small caps were really the laggards. And that's kind of one of the things that we think may play out over the next couple of years is catch up of some of these small and mid-sized companies. We break this down a little bit more into the various regions because I think it's important to understand that these returns get driven by different factors in different markets. So you can see at the top left-hand box, this is the returns in the US market, and that returns were very much driven by those large cap growth, mega cap technology companies. Small and mid caps did okay, but value definitely was a laggard. Whereas then you contrast that with Japan. Japan was all about value. So a lot of the traditional Japanese companies, Toyota Motor, some of the banks did very well. So completely opposite to what happened in the US market. The UK was very much similar returns across the board, and Europe was very much a large cap story. So I wanted to just put up this pie chart just because this is the sector breakdown of the index. And I really just want to emphasize how important the technology sector is in terms of driving returns of the overall benchmark. It's over a quarter of the benchmark exposure. And so what happens to that technology sector is going to heavily influence the overall returns of the market. Splitting that down even more, you may have heard of the Magnificent Seven name. This is 7 of the mega cap technology companies that have done very well. They make up 20% of the index. So we saw on the last slide the technology sector and how influential that is. These 7 companies are very important in terms of driving returns. NVIDIA in particular and Microsoft have been very strong. And we show that on this slide, so you can see NVIDIA 225% gain on the year. And that contributed a lot to the market. And you can also see Meta, Amazon, Microsoft, Alphabet also far exceeded the overall benchmark returns. Only Apple, which has done very well over the last decade, was beneath the market, and then Tesla, which some people say shouldn't even be in the Magnificent Seven anymore. I'm not going to make any comment on that. But is definitely a stock that has a lot of people's attention. So what exposure do we have? We have exposure to all of these companies, but we do not have the same exposure as in the benchmark. And that's because we invest in closed-end funds. If you look at the sector ETFs of the technology sector in the US, it actually underperformed the technology index by around 400 basis points in the first quarter this year. And that's because those funds cannot have as much of the big companies in those ETFs. So even if you bought the ETF, you would not have got the returns of the sector. We invest in closed-end funds, so we have some exposure, but we don't have benchmark exposure. And that, is a challenge when these companies do particularly well. But we do also get exposure to some companies which aren't in the benchmark. So you can see a couple from the bottom, Taiwan Semiconductor, that had a very strong return. It's not in the benchmark, but we benefited from having that exposure. So in terms of overall performance, the Tradex Global Equity Fund returned 22.5%, that's net of all fees. That lagged the benchmark, which is the MSCI World, which returned 25%. The Dow Jones is another benchmark that returned 23%. The average Canadian Global Equity Fund returned just under 19%. And the 2 indices at the bottom are the indices of closed-end fund returns. So this is the universe that we're picking from. And as you can see, those returns are pretty weak relative to the overall market. And that's some to do with the composition of those indices, but it's also to do with some of those funds being out of favor. What drove our returns was we got some benefit from discounts narrowing over the period, and this is shown a little bit on the size-weighted average discount. This is basically looking at the weighted discount of the overall portfolio. You can see it's narrowed actually quite a bit. Part of that is because we have some funds in the portfolio which have fixed lives, and that means that we will realize the discount at the end of that life. And so they're coming towards that life, and so the market naturally prices them at a smaller discount. And so that's reflected in the size-weighted average discount. So I've entitled this slide Barbarians at the Gate, which is a title of a book about some corporate raiders in the 1980s. And it really reflects the fact that closed-end fund discounts are particularly wide at the moment. So even though we got the reasonably strong returns, discounts continue to be wide in our sector. And there's a cycle to closed-end fund discounts, and what happens when they're particularly wide is you start seeing hedge funds coming into the market to take aggressive positions to narrow those discounts, which effectively takes capital out of the market and brings those discounts more into equilibrium. So this is what we've seen over the past year. We've seen, these are newspaper headlines about activist positions and the fact that discounts are particularly wide. And this is going to create a tailwind for our strategy, because we are likely to see funds which will have tender offers and other events. So one of the things we've got on this slide is, so there's a much higher focus on corporate governance within our within the closed-end fund world. So what we're seeing is elevated levels of share buybacks, which are accretive to the NAV performance and also help balance the supply and demand. We've seen mergers of funds. We've seen some manager changes when they've been underperforming, tender offers, liquidations, these fixed terms and continuation votes, and increased distributions. All of these measures are positive in terms of overall returns and going to help bring the market back into equilibrium and narrow those discounts. These are the top 10 holdings, and I just want to kind of highlight a couple of things. One, you will note that the top 3 of the top 4 holdings are all technology oriented. We have a good amount of exposure to the technology sector, and you can see that there's still a reasonably wide discounts. If you go back 3 or 4 years, Polar Capital Technology traded at a premium. Polar Capital Global Financials, who they do a number of sector funds, that's a fund that has a fixed life, so it's traded at an 8.9 discount, but that's going to get realized in 2025. And similarly, Miller Howard, that's a fund that actually should self-liquidate in November this year. Moving on to kind of the themes from the past year, it was a environment where the US economy was in particular very strong, stronger than many expected. If you go back 12 months, there were a lot of people calling for a recession. That hasn't happened. What we also have seen is declining inflation, albeit not to the central bank targets. Very much the theme, particularly over the last 6 months, has been artificial intelligence with the release of ChatGPT, and these companies, NVIDIA is a major beneficiary of artificial intelligence, but we also think that there are other kind of secondary effects that could be interesting there. We've had elevated geopolitical risk, not just Russia-Ukraine continued situation, we've had China-Taiwan, and also what's going on in Israel and Gaza, and the involvement of Iran there. All of these factors do kind of raise the temperature, if you like. And China has definitely been very much a laggard over the last year. They've had a lot of problems in their property sector, and very much the government there is kind of clamping down on business generally. So not a great environment. Not a great environment for foreign investors. We've seen a lot of flows out from non-Chinese investment people. So, who's excited about the Biden and Trump rematch? I don't know that actually that many people are that excited about it. It seems like, I've included this chart here, which is from one of our brokers, and the point is that if you go to the extremes where if Biden wins and there's a Democratic Congress, or if Trump wins and there's a Republican Congress, then you have more extreme outcomes. The likelihood is that it's going to be a divided, where you'll have a president from one party and a Congress from the other, in which case the outcomes are not that dissimilar. One thing which is likely is that nobody is going to address the deficit. There is likely to be more tax cuts overall. It just depends what kind of flavor, and definitely no kind of cuts to entitlements. So the point is that, we don't know what the outcome is going to be. In general, if we get the divided, it's almost like it's better if they can't do very much. And actually, that's worked out very well for the US. So the outlook, obviously, interest rate policy. We've had the Federal Reserve meeting today. Inflation, as I mentioned, is for the moment elevated. We think it will come down a little bit, and we still think that there probably will be an interest rate cut this year. We think the presidential election will undoubtedly be a distraction, create some volatility, but overall, generally, markets do pretty well once the election takes place. The UK also has an election. This could be quite interesting because the Conservative Party, which is in power right now, is doing very poorly, and the UK market is also in some disarray, and so the new government could result in some positive measures there. Commodity market strength. The AI boom is going to need a lot of resources, a lot of electricity, and that is likely to be supportive of certain, not all, but certain commodities. And then one other area that we're particularly focused on is not just the Magnificent Seven tech companies, but tech companies in the emerging world, those Taiwan Semiconductor, Samsung Electronics, and some other emerging market technology companies. So with that, just summarizing overall, discounts are wide. We think there's lots of value within our portfolio. We think the economy is finely poised, but is likely to generally be reasonably good, albeit we do think there will be interest rate cuts that will be supportive to our positioning. And we're overweight markets where we think there's better expected returns. Japan has a corporate governance improvement going on. Emerging markets are particularly cheap right now, as is the UK. The UK market, actually, we've seen a lot of small and mid-sized companies getting taken over because those valuations are so cheap. So we continue to be overweight there. So with that, I'm pretty sure I've gone over 20 minutes, but I'll happily take any questions. Yes.
I'd like to congratulate and thank City of London for some awesome performance, and after 25 years, you've made me a believer. And last year I kind of questioned things, and you stuck to your knitting, and again, thank you for rewarding us with such performance. I have one little question on the performance. You did something called attribution analysis.
Yes.
I appreciate that, and I noticed that you said that relative performance was affected by, it said 2.6%. Is that net? In other words, you did 22 last year, which is phenomenal, but had you got it perfect, would that have added another 2.6 to your performance? Is that how I would read that, or do you recall?
I think if we'd have returned in line with the benchmark, then yeah, it would have been 2.6% higher. But
that's not far from perfect, or is it?
I wouldn't say it's perfect. I mean, I'd say I think it's a pretty good result. I think if you look at those indices and the universe of securities we're picking from, that's a pretty good outcome, particularly as in order to get a market weight in those Magnificent Seven stocks, we'd have to have like 20% positions in Polar Capital Technology, because that fund itself is underweight those names. And so, personally, I don't think that makes a lot of sense. And I think that having a diversified exposure will be will be best. But I think overall, while I always want to beat the benchmark, I think a 22.5% return is pretty good, and given the universe we're picking in is decent, But there's always room for improvement. It's the biggest room in the house. Yes. Yeah.
Slide 17, please. I just want to know what's the main reason for the discounts. When I look at BlackRock, you're looking at 11.6%, Pershing Square 25.7%, and JP Morgan 8.9%.
Yeah.
Everybody's in the same market, having the same information, and operating in a similar way. What's the cause for this discrepancy, or this major difference, I would say, in the discounts?
Yeah. So,
Mike, can you just repeat briefly the question, please?
yeah, the question was looking at the holdings on this slide and the different funds. You can look at the BlackRock fund, which has a 11.6% discount. Pershing Square has a 25% discount, and JP Morgan Japanese has around a 9% discount. So why are these different? So there's not an easy answer to that, but it depends on the governance. So Pershing Square, for example, is structured much more like a hedge fund. It has a more complex structure, more layers of fees in there, and actually that discount has been as wide as around 38%. So when we're looking at these closed-end funds, we're always looking at the closed-end fund discount relative to its historical trading range. And so what happens in markets is people get anchored to whatever level they're used to seeing these funds trade at. And so likely, if you bought a fund at a 38% discount and it's traded into a 25% discount, if you don't think that discount is going to narrow much further, you might want to sell that position at that point, even though on an absolute basis it looks pretty attractive, but it may be highly unlikely that someone's going to bid that up, so it gets a lot narrower. The BlackRock fund is invest in mid and small cap innovative companies. It launched in mid 2021, which was close to about the worst possible time it could have launched. It raised a large amount of assets, and so that net asset value has done very poorly since that time. And so this thing has traded out to around 22-23% discount at times. So 11 is actually narrow, but it's narrow because there is an activist investor taking a big position in that fund. One of the headlines on the Barbarian slide was about a hedge fund taking a position in BlackRock funds, and this is one of them. And so that's why that's there. JP Morgan Japanese is really a function of just where the board is buying back shares. So it has traded wider, but it's effectively regularly buying back shares at around that 8-9% discount. So that's kind of why it's trading there. But again, that has traded at a premium. So the whole point with this strategy is that these discounts vary over time, and so we're managing the position sizes to be bigger when the discounts are wide and smaller or non-existent when they're narrow or trading at a premium. Yes.
Are you able to go in and out of these funds?
Yes.
As and when the market is favorable to you?
All of these funds are listed on the stock exchange, and so we're able to buy and sell shares on any trading day the market's open. Any other questions? Yes.
I'm just wondering, the returns that you're getting for the Tradex Global Equity Fund, is that before or after management expense commissions? What is the amount?
So it's the number in here is after all expenses, and the MER is.
So the new audited MER is 3.06, I think is the number. But that's, in my view, misleading, but it's the regulatory number, so I wouldn't argue with it. But the cost, if we compare it to buying, so they buy and sell items that are listed on exchange, same as the other funds buy and sell stocks listed on exchange. So if we didn't worry about what's happening inside the closed-end funds, it would be 2.26, or 2.06, sorry. And the average for the global funds is now down to around 2.26. So to me, the cost, and the way we reported up until about 5 years ago, because that was the rules then, it would be a low-cost option, but we have to add on the expenses that are inside the various closed-end funds based on, and those expenses are charged against the NAV. There's nothing charged on the price level at the funds. And so when we buy, say, Pershing at 70 cents on the dollar, to me, the math should be down that at worst, we would say, okay, you're paying 70% of what the fund is paying. But that's not the way the regulators have us do it. But all of these numbers are after fees. And all indexes, as Gabriel mentioned more than Mike, are before taking any kind of reality as to what it would cost to hold all of those.
Yes.
I was looking at, I think it's page 5, your market performance, and no, it's sorry, your sector performance. There doesn't seem to be any mention of aerospace and defense industries, or is that just looped into industrial?
Yeah.
Why is it mentioned?
Yeah, aerospace and defense is a subcomponent of the industrial sector. It's done pretty well. Yeah, and I think it's probably the best performing subsector of that industrial sector. But if we listed all of them, we'd have like 53 different subsectors. So, but yes, that's what it's part of.
And where would energy come?
So energy has its own sector.
Oh yes, I'm sorry.
And that has various subsectors within that as well.
Does that include companies, electrical companies, and those type of operations?
So the electrical companies typically are in the utilities sector. So energy is much more kind of oil and gas, mixture of exploration, production, services, and some kind of transportation type companies. Any other questions? Okay, well, thank you very much, and thank you for your support with the fund.
Thank you very much, Michael, for your remarks. Now I'd like to introduce Andrew Mitchell and Dylan Ray from Phillips, Hager and North Investment Management Limited, who are the portfolio managers for our Tradex Equity Fund.
Okay, great. Once again, wonderful to be here. The surprise tonight is we're actually here where the Leafs are still potentially alive. That never happens. And the surprise probably is that, or the not surprise would be, we probably won't in a week's time see the Leafs still in the playoffs. In terms of tonight's festivities and the key comment I think I want to make to all of you is thank you very much for 32 years of partnership. together. It's hard to believe, but I think there's been 3 of us here working with you over that period of time, which is tremendous. And there's been tremendous consistency in the message that we've been given from the Tradex board and management team to focus on the long term and try and provide something that's very unique for all of you in terms of vehicle that can be a comprehensive equity vehicle for you and hopefully give you an attractive long-term return. So we appreciate the chance to partner with you and partner with the management team here. One of the things we've seen over a long period of time, and we like to start with a little bit of lightheartedness, is that in various periods when I've been here, the markets can be going very, very robustly up, and people are very excited about the future. As this gentleman is here, some of them are looking with rose-colored glasses on the left-hand side at the boom to come and continue, and others are always worried about, the potential for a collapse. And day to day, this is really a reflection of, I think, one of the key tenets here, which is that there's going to be a lot of emotion in investing for all of us. It's our hard-earned savings of a lifetime. I think for many of you here, it's normal to be emotional about it, but it's so important just to recognize over the long term the impact of just staying committed. This is another cartoon that's actually just a great way to capture it, but just how quickly things can shift. Last year, in the last couple of years when I was here, there was a lot of concern in markets with interest rates getting ratcheted up. Of course, we're never out of a laundry list of concerns. There's always lots of reasons to be concerned. There are this year as well. But of course, the backdrop can change, and one of the things that's been fabulous over time is the way that the world can kind of find a way to rebalance itself and start to find a way to heal and get back to a more constructive environment. But in the midst of that, one of the most damaging consequences can be sort of listening to the talking heads that are going to discourage you from continuing the long-term story. As I look back, this is only partially to the credit of the portion of our partnership. You should have enormous, I think, pride in what Tradex has accomplished for you, regardless of the manager that's been on board. And one of the things that's quite interesting to see here when you look at this slide is that your compound return is 9.3%. You started off as a Canadian equity fund. Today it's comprehensive, it's taking the composition of global equities. And so those are decisions really made by the management team and your board, and they've paid off well for you. The combination of the focus on fees and the combination of that with a comprehensive equity vehicle has really paid off for you. The piece that we try and bring to the table is giving you, a focus on some of the other things that we think will matter to you. There's a growth orientation to the portfolio. We don't dive so deep into that style that we're going to overexpose ourselves to businesses we don't think will carry themselves through, or businesses that are concept stocks. But we do believe in having a growth orientation in the portfolio, as does the management team, and that's been one of the key characteristics is paying off. A long-term oriented mindset in terms of the way we're thinking about that, but again, not wanting to focus on far-fetched concepts. And we're going to focus on things like, leveraging all the capabilities we have in bottom-up stock picking and that comprehensiveness that we've talked about before. So those are some of the key characteristics. In terms of the performance report card, what you're going to see here is giving you a sense that, from a performance standpoint, we haven't been as successful, and I'm not as satisfied as I have been before, and you wouldn't have been before, with our performance over the past few years. So what this is showing you the annualized returns versus the peer group. The peer group is the Canadian Focus Equity Group, and you can see over the past few years that's the toughest spot for us, and we'll speak to you about what the factors are that have been causing that. So the absolute returns are good when we consider what we went through. Everybody was worried that markets were going to fall off with the ratcheting up in rates. The absolute returns are still to the positive, but could we have done better? Absolutely. And the bottom part shows you our Morningstar quartile ranking. So you can see how many funds, opportunities you have in this space, and you can see our quartile ranking. So if you're in the first quartile, you're at the top 25%, second quartile, you know, the next 20, sort of 26 to 50 and so on. And you can see that from an annualized standpoint, we've fallen back and we're hopefully turning the corner now back into the green, getting back into that top half. But that's disappointing for us. Where you can see the impact is really in that period where rates did ratchet up. That's where that performance for us relative to the peer group average, so this is now looking at annual returns. So where did we fall behind? The answer is towards the end of 2021 and then really going into 2022 and 23. So that's giving you that sense. That was primarily coming from the global piece of our portfolio, which is typically about 35 or 45 stocks to build in that comprehensiveness into your portfolio. So we'll speak to you about what was challenging there for us in terms of market dynamics and what were the self-inflicted unsatisfactory aspects in terms of our stock picking. So we'll give you a sense for that. But at the bottom you can see, you know, in a sense, the team that has underperformed recently has obviously been a very big factor to the prior strong outperformance versus other managers, and has been turning the corner. So that is a very transparent sense of the report card. We're certainly not satisfied. We like to be up in that top two quartiles on as consistent a basis as we can. So recent performance challenges, and I'll give you some enunciation on a few. And what I'm going to try to do is give you a flavor with a few pictures. But certainly, if you're a growth-oriented manager, not deep into that, but you've got a growth tilt in terms of your style, and we certainly do in Canada, and also in terms of the comprehensive. In this, we're trying to build in terms of having global juggernauts in the portfolio. That was a difficult place to be in 2022, and the headwind has been thankfully turning into a tailwind as we go into 2023-24. But that was certainly a challenge. We made some mistakes, so there's lessons learned and some incremental changes in the portfolio that of course have been executed. And then we are dealing as well, as many of you know, in a very highly concentrated performance world right now with a few stocks that are really driving all of the returns. So for most of us as active managers, that does present a challenge. So we'll give you a sense pictorially of what that looks like. So this is just giving you a sense of, if you look at, you know, globally outside of Canada or even including Canada, the developed markets, 70% of the developed markets are in the US market. And within the US stock market, you can measure how are the growth stocks doing versus the value stocks. And the growth stocks have had a very good trend, so a favorable tailwind. But when the rates really ratcheted up in 2022, they started to underperform. And the way you would read this is just giving you a sense. This is a quotient with the performance of the S&P 500's growth stocks divided by the S&P 500's value stocks. So when it's going down, the growth stocks are not performing as well as the value stocks. And so one of the headwinds for us with a growth tilt is growth underperformed by about 30% as rates ratcheted up. So it gave back some of the longer term outperformance that we've been able to see with that style, and now it's starting to come back. But you can see there's a gap there still to go. So that has certainly there's been a headwind, and what we've seen in terms of the movement back for growth stocks has really been very concentrated leadership. The self-inflicted part, you know, that it does combine style with stock picking. This is just giving you a sense within our global portfolio for how much of the portfolio's capital was outperforming. So in green, if you're in our business, if you're getting more than 50% of your capital outperforming in any given quarter, as you can imagine, that's good. It's telling you you're going to have a very good shot to be outperforming, and anything well beyond that 50% is excellent. It's a bit like baseball that way. You know, when you look at somebody's on-base average, it doesn't always blow you away. You sort of think, well, if they're only on base 30% of the time. When you think about your capital in a portfolio, you probably experienced this in terms of how the influence is. The yellow light, red light zone is when we're below that 50%. And that was a combination of style, but also some of our stock picking, unfortunately, was not as strong as it could have been. We've been starting to turn the corner and reassert ourselves. And part of the driver for why that's been happening is captured here. So this is a bunch of squiggly lines with some alphabet soup below, but I'll try and make this simple for you. So we, from the global stock standpoint, think of all companies as A, Bs, or Cs in terms of the quality of the company. So if you think of something like today a Microsoft, or you think of an Amazon, which we own, or an NVIDIA, we think of those as A-quality companies, companies with this sort of very strong global leadership position. They're in a market that's growing faster than the economy, they're picking up market share, and they're doing all kinds of fabulous things, and they have some very strong competitive advantages. And so those kinds of companies are A's, and then if they're A1 rated, that blue line, then we think they're reasonably valued. So that's led us to own some good companies over time. So our portfolio is typically about 5% composed of these A1 companies. And so you can see good outperformance for those, so that works. The challenge more recently is you can see that the gap of outperformance narrowed. And so that's that period where we've had headwinds both in terms of style and stock picking. And then what's hopefully positive news for us is you can see we're getting through that on the other side, we're starting to re-accelerate. So the gap is starting to widen out again. But that gives you some diagnosis in terms of what's happening under the hood in the area that we're most focused on. One other thing that's affecting all active managers globally, and this is just a little bit of a picture for you. So this would be kind of you hear about the Magnificent Seven. This is, you might say, the Magnificent Eight. The other company that's in here beyond the ones you're aware of is Lilly. So Eli Lilly, as some of you would know, is very much into the same areas that you're reading about a lot right now. You've heard about Ozempic. That's owned by the drug company. We actually own Novartis. But in the United States, Eli Lilly is also in that area, that diabetic drug, weight loss drug that people can inject into their bodies, and it's been approved for that. So we call it the Magnificent Eight. These companies have been by far in the leadership position. So all the returns in the first quarter are essentially coming from these companies. Now, as we're moving forward, what we have taken note of that we'd like to see as active managers is more dispersion is unfolding. As you've probably read about, Tesla has been having much more of a gyration. It's not performing amongst the top companies anymore. Apple isn't performing amongst the top companies anymore. So we don't own those two. That's helpful to us, but also it's just sending a message that there's more market dispersion, more variance in how things are performing, and that's good news for bottom-up active stock picking. It's a tough time when you have all the returns in the market really being produced by a handful of stocks, and it gets to be more differentiating for active managers where you're trying to get diversification if you can get more companies zigging and zagging. So with that, I'm going to turn to Dylan to speak about positioning and give you an update on the portfolio. And I should mention, thank you. We'll focus on the global side quite a bit in here, just to give you that update in terms of how that's positioned given the performance.
That's great. Thank you, Andrew, and thank you all for having us. It's great to be back here in front of you again. So just spend a moment just going through where the portfolio is currently positioned in terms of the kind of stocks we own and proportion, and then giving you a sense as to where we're positioned on a regional basis and on a sector basis. And of course, with this portfolio, we would define it as a Canada Plus type fund. And what we're trying to do is blend the best of what we have in our Canadian market with what we don't have, and particularly on the sector side, what we really just don't produce here in Canada. And you can see here just on the left-hand side, we're highlighting the blue highlights, if you can see them, are the Canadian companies, and the yellow is global. And what you would notice is what Canada tends to do well, what we like, are areas that you expect, the banks. We have first quality tier 1 global banks. We have good energy companies in terms of profitable and well run. And we have some really good areas maybe in industrials to some extent. But what we lack, of course, in our market are things like technology and healthcare. And so that, quite naturally, you'll see here is when you look at the global holdings, that's really where they focus in on. By adding global as well, what we end up getting is a more diversified portfolio from a sector level. So on the top right-hand side, you can see the breakdown by sector. If this were Canada only, of course, you would end up with a large weight in financials, a large weight in energy, but the other sectors much smaller. And from a risk management standpoint, of course, and from a long-term growth standpoint, that's not really beneficial, and that's what we're trying to avoid. So by adding in global, we're getting a lot more exposure to sectors and areas that we can't get here. The final point, just to give you a sense as to where we're positioned in terms of regionally. Of course, this is a Canada first type strategy, so Canada remains the largest of the weight. It's in and around 57% of the portfolio currently. The remainder being mostly global, and within that, that's primarily the United States, and that's largely just the function of really, if we're looking outside of Canada, Europe and developed markets outside in Asia. They tend to have the same kind of problems that Canada has, but they don't really have a lot of the sectors and the growth companies that we really want to find, particularly at this stage in where the markets are. So within global, you're seeing a lot more United States companies than maybe you would have seen about 10 years ago. You might notice there's a little sliver that does emerging markets. We don't have a standalone dedicated approach to trying to find emerging market companies, but we do own the handful of companies in emerging markets that are really global companies. And maybe the best example that you hold in this portfolio is a Taiwan Semiconductor. It is the biggest producer and most important producer of semiconductor chips in the world. They make all the chips that are designed by companies like AMD and NVIDIA. And so we feel that that's really a global company, and as such, it really fits into this portfolio. I'm just trying to give you a sense as to we dig into the top sort of 25, and to give you a sense as to what we're thinking about now, and what themes are sort of driving our positioning in this portfolio, both at a company level and at a sector level. And you can see it really across the top. The headline being, we are getting a bit more constructive on a soft landing, and a soft landing, particularly in the United States. And what a soft landing means is effectively that, amazingly, the Fed seems to have engineered, at this point at least, a pretty good outcome for the economy, and that they've managed to raise rates to a level that so far hasn't really broken the back of the U.S. economy. We're seeing earnings come up strong. We're seeing the U.S. consumer hold up well. We're seeing jobs in the U.S. hold up really well. And so that's giving us some optimism in terms of what the future path of the U.S. economy in particular looks like. Now that being said, there are still some risks under the surface that we are mindful of and that we are spending a lot of time thinking about. On the rate shock side, 2.5 years since they've started the rate hike cycle, typically we would have expected to see some weakness as a result of particularly how quickly they raised the rates. That's of course happening here, and that's of course happening in other markets, but it's not really happening in the United States yet. Some of that likely due to the fact that in the U.S. you can get things like 30-year mortgages and lock into them, of course, and because their job market's so strong, people have been able to sustain it. But we haven't really seen the kind of shock that I think a lot of people had been expecting. Of course, a year or two ago, people were expecting we'd be in a big recession by now. That hasn't happened. Inflation, also on the radar, it has come down. It's come down quite materially, but as we're getting closer to the Fed's target, it is proving stickier, and that's something that historically has been the case, and that's something, of course, we're watching. But the trend of inflation is positive, and we think will likely remain so. The other two risks, geopolitical and earnings. On the geopolitical side, clearly we're in a new regime. That's not likely going to change. There's not much you can do on an asset management standpoint to really predict what's going to happen. All we can do is just try to make sure that how we're positioned in the portfolio is one that's mindful of where these risks might be and try to avoid areas that might be riskier than others. And I think if you look at where we're positioned sort of regionally, that again leads us a bit more into the United States, where you don't have as much of that geopolitical risk, certainly as you might have in other regions like Eastern Europe or even within parts of Asia. Finally, the one factor that will determine really where the markets go over the near term is earnings. Earnings for U.S. companies continue to be strong, and they continue to guidance higher, which is incredible given the backdrop, but just really shows the resilience that market's been able to endure, largely as a result of technological innovation, which of course we'll get into in a few minutes, around things like AI that are effectively creating new industries and really creating a lot and producing much better productivity in U.S. companies that alone is helping manage costs and drive overall returns. In terms of the sectors, and giving you sort of a sense as to the sectors, how we're playing them, the kind of companies we hold, maybe I'll just highlight two. Financials, of course, in Canada, we're all very familiar with. I mentioned we have terrific banks, and of course we own many of them, TD, RBC, and BMO we're highlighting here. On the global side, though, we want to complement that with parts of the financial sector that we can't get here. So payment processors, Visa is one that we quite like and have held for a few years now, and asset managers. And when we think of asset managers, we're thinking of alternative asset managers. So a Blackstone, which is big in alts, and a Brookfield, of course, which is a Canadian company, but active very globally on the real estate and private market side. Within industrials, again, we know we have world-class industrials in Canada, particularly in our rails. But the risk in industrials is always that tends to be a very cyclical sector. So what we're trying to do is blend that with areas of the industrial market that are less cyclical. Maybe the best example of that is waste connections. You know, garbage gets collected, and the markets are good or bad, or in a recession or not. So we want to complement that with the more cyclical areas, like you'd see with a John Deere, or of course with our rail network. So we can't go through a presentation and not talk about AI. One thing we thought we'd bring to this discussion is when we look back at really disruptive sort of technological advances, what we've seen is they tend to get adopted quite quickly. And this is just showing, you can go back to early 1900s and we look at things like radios and electricity. But what's interesting is as we've progressed as more of a modern society, you can see that the adoption rate is becoming more linear. We're adopting things much quicker. And we really think AI will likely have perhaps the steepest adoption rate, just given how ubiquitous it will be to all industries in terms of their ability to implement it quickly. When we think about, certainly in the technology sector, that makes sense, and we can imagine companies like Facebook or Meta and lots of the tech companies in the US on the social side being able to use it to mine their data and be more efficient with that. But if you think about banks, traditionally slow growth, traditionally ones not to adopt technology maybe the quickest, and as RBC employees we can attest to that in lots of areas. We think of the banks have lots of functionality, lots of roles that are repetitive, that are error prone, and that AI really will be a key tool, we think, going forward. We can think about industrials, we think about how car manufacturing, so many different sectors are going to be able to use and apply AI, and we think the adoption rate will be quite steep. And I think as a result, that's why you're seeing a lot of the optimism out of sort of the early companies that are most important in AI. And of course, there's none more important that we all know, which is NVIDIA. NVIDIA is a holding. We've held it since 2019 in this portfolio, so we've come up to about 5 years. We liked it, certainly when we purchased it initially, we liked it for lots of reasons, and its core business, which of course was graphics cards. But what we've seen really, and you can see this just in terms of the revenue numbers over the last 5 years, it's effectively a completely different outlook now for this company. You can see revenue of 11 billion in 2019 versus 60 billion today. This company is really sort of the core pick and shovel, if you will, for the AI business, and we think is going to likely be perhaps the most important company, at least in the early years here, of AI. And of course, we're certainly not alone in that point of view. We're highlighting on the left-hand side are some of the other companies that we own in the portfolio that we think will likely be sort of the next tier beneficiaries. Of course, you imagine that, as I said, Microsoft, Google, Amazon, the hyperscalers, the large data sets that likely use it immediately. But over time, we do think things like Intuit, so tax software. I mean, the tax code can't get any more complicated. It can't get any more. It continues to get more complicated. Having an AI tool to help you sort through that and manage that can be quite beneficial. We can think of pharmaceutical companies or healthcare companies that are developing new drugs, and the amount of time and research that they have to spend doing it. Well, AI will obviously be a huge tool in them, help them get products tested quicker, help them develop quicker, help them get things to market quicker. So really, it's incredible to just imagine the application of this going forward. The other thing to keep in mind here, and we wanted to put that in here, is you can see that while we did buy it in 2019, we did experience in this portfolio a 66% drawdown in NVIDIA over the 2 years, 1.5 years really, from early November 2021 until late 2022. And that's actually the case with a lot of the companies you can see on the left-hand side, Microsoft, Google, Amazon. These all, of course, a year ago we were coming here and saying, presenting reports and performance where these companies have fallen quite dramatically. So it's a good reminder that particularly, you can go through cycles and you go through short-term cycles, as Andrew just pointed out within the markets, where these companies, for reasons that are completely unrelated to their own business or their future prospects, get hit hard in the market for things like interest rates rising or certain near-term fears. But if you have long-term conviction and you really understand the fundamentals of the company and you can stick with them, you really can see the payoff over time. And certainly we think that's the case with a lot of the stocks in the portfolio that are now starting to rebound, I think, as the market's starting to get confidence and the rates are certainly a bit more stable, and that their future outlooks now look a lot brighter than maybe they did a year or two ago. On that note, maybe just highlighting a couple of the companies that we think were in the portfolio and are sort of core holdings in different sectors. The thing to point out, I think, here is that because this is a fairly concentrated portfolio, these are all fairly material weights. So 1% or more in the portfolio. You'll recognize a lot of these companies. Again, this is the completion strategy in terms of companies that are not in Canada, but ones that we think fit well in the portfolio because they bring a lot of attributes that we can't get within our own global market. And ultimately, these are global leaders within their own right. And many of these have been long-term holdings for us in the portfolio. So maybe just to leave you on what we've been up to in the last year and some 2 additions that we've added. So of course, last year there was still a lot of weakness, particularly on the technology side, and we used that as an opportunity to add to 2 companies that have been on our watch list for a number of years, but for reasons, particularly around valuations, we weren't prepared to go into. But given the correction we saw in the market, we thought this was a good opportunity to do so. Salesforce, you might all be aware of. This is one that most companies use to sort of manage customers and manage business growth. It's one we've highlighted a minute ago in terms of one we think will be a big beneficiary of AI. Anyone that uses Salesforce as a user knows you spend way too much time trying to figure out the interface and add all this data. And AI is absolutely going to help in that regard. And Netflix, of course. Netflix has done quite a good job in terms of attracting new subscribers, but they've done an even better job of kicking people off that aren't paying or sharing their passwords. So I can tell you firsthand that it's increased my household budget as lots of people have been not allowed to share passwords anymore. And what we're seeing is really this is becoming a global media company, and we think of their long-term growth. It's certainly stabilized in the United States. When we think about areas, particularly in emerging markets, we're seeing Netflix really starting to make inroads, places like India, places like China, and we think that's likely just going to continue, given that they have such a strong production component now to them as well, and have done a great job in terms of cracking down and trying to get profitable by sort of streamlining their business and make sure people can't get away anymore with all password sharing. So you can see here, just in terms of subscriber growth, continue to grow pretty materially. And both these companies are now, if you go through the deck, you'll see, have been material contributors to the fund's performance over the last 12 months. So with that, I'll pass it back to Andrew to talk about where we think the market may be going from here.
Well, the first thing to know about the market outlook is we certainly have no idea what happens next. What we can try to do is give you some touchstones. And one of the first touchstones we sort of talked about was how easy it is to get distracted in the day-to-day noise. And I thought this was this is a very fitting chart because it from the end of 2009 and then it takes it forward into 2017. So you get a period you can probably all reflect on in this room, just judging by our weighted average age, where you remember all these headlines, and there were just so many negative headlines and events, and through it all, there was all kinds of reasons that people could have thrown at why now was the time to sell. And if you get it perfect, you can see there were some optimum moments when you could actually hit the sell button, but you had to get back in. And ultimately, over time, many of those periods were also the wrong times to sell. So it's if you remember nothing else from what I've experienced and learned, it's essentially you got a 70% chance of getting things right on any given day. You just hang on. And so 7 out of 10 days, 7 out of 10 months, 7 out of 10 years, things will work out okay. And over the long term, you got to try to avoid the reasons to sell unless you think you've got the crystal ball to know when to get back in. Right now, one of those reasons is so, that we've been hearing about over and over again. In fact, I can remember hearing about this probably 7, 8 years ago. And the story was that the US stock market leadership was concentrated, okay? Fair enough. The multiples were high. Technology was leading today. A lot of different things that we have seen at various points in time correct. And one of those points in time that people refer to is, back in March of 2000. And that was when we had that gigantic tech bubble. But one of the distinctions you can see here when you look from the left to the right is, okay, we did have a fairly concentrated market in both periods. And you can certainly see on the left-hand side, there's some companies that continue to go on. There's some companies that died, like Lucent's buried down there, went bankrupt. Nortel, the same thing. So there's certainly some disasters in here. One of the distinctions, though, is you can see the valuations were quite different. So it's easy to think of, experiences, and human beings are good at this. We do know history tends to repeat itself, but it's always a bit different. And so we're always looking for that sort of rhyme, that repetition. But it is also dangerous to reflect on things without the facts. So the facts at that time are quite different in terms of valuations. They're also quite different when you look at the companies on the right-hand side, and think about the environment we're in today, because back then there was, some of these companies were fabulous earnings producers, but underneath the surface, the giant bubble that exploded was, there was a whole bunch of companies in the NASDAQ that weren't producing earnings, were never going to produce earnings, and certainly didn't have any free cash flow. And so when the ride stopped in terms of just being able to raise money from investors, it was lights out. These are companies today that have some of the most fabulous profit margins we've ever known, and some of the most tremendous capabilities to produce free cash flow from every dollar of earning. And they certainly have strong valuations, so I'm not arguing that these aren't robust valuations. But what they've been able to do so many times so far is actually earn their keep by generating tremendous earnings growth. And probably the second thing I'd leave with you tonight is what matters most is certainly earnings growth. Earnings growth is the most powerful piece of it. Valuations do oscillate, but earnings is what will get you through and what's generated all that growth with Tradex. One of the other things that markets worry about is where rates are, inflation, all these kinds of things, and these are reasons to potentially, sell. And they're real. If we go, if inflation gets out of control, if rates get out of control, you can see valuations get compressed. So what these are showing you is the bars are showing you the valuations in the stock market. And given where we're at today, it's interesting if we do fall into this zone here where CPI stays out of trouble and sort of gets 4% or below, that's kind of in the sweet spot for valuations on the stock market. On the right-hand side, you're looking at rates. We're already in that sweet spot for valuations in the stock market. So when people say the market's expensive relative to where rates are, then again, the facts, you can shape a variety of ways, but ultimately, the facts over time that suggest we're in a reasonable range to have a strongly valued stock market. What matters most, though, as I said, is earnings. And one of the reasons, I would have been more constructive last year is the potential for resilience in earnings, and the potential for resilience in earnings in what matters most, which is the U.S. And the U.S. is right now 70% of the developed world's market capitalization. And on the left-hand side, you don't have to squint too hard here. I know you have the charts in front of you, but what this is showing is the earnings pool for the S&P 500 in the U.S. And so what this is, what's kind of magic here is that we think about all kinds of issues around the United States. Canadians, I would say there's a generalization, but love to point to the flaws in the United States. But one of the flaws that isn't there is the power of the innovation in the United States. And as much as people have been calling for the end of the U.S., if anything, you can say they're more powerful than they've ever been in terms of the developed markets from a corporate standpoint, corporate earnings standpoint. When you look at the left, you see that around the credit crisis, they were earning sort of somewhere around, sort of $60 and maybe a bit higher in earnings. Today, they're headed towards somewhere in that zone in the mid 200s. And on the right-hand side, you're seeing the forecasts. And the forecasts, ironically, have often been underestimating where the earnings growth is going to go in the United States over the cycle. Time will tell when that stops, but they've actually been beating expectations on a consistent basis. And that's why these things hook up. Each quarter, there's earnings surprise, positive surprise. This is unusual. Normally, earnings expectations kind of curl down. People are too optimistic. People like me that have been in equities for a long time aren't there because they're pessimists. You wouldn't want to own a business if you were a pessimist. You would want to potentially own a bond or supposedly gold. So this is telling you something very unusual is happening, and when you think about this effect, if they actually manage to get to 300, just think of that. That's 5 times the earnings pool. You can't find that anywhere else in the world today. Canada is a deep underperformer relative to this. Europe is abysmal. If you look at the most important sort of heartbeat of the developed world economy, right now, it's pretty robust and pretty strong. And at some point, obviously, something will change. But right now, if we look back to those companies we were looking at, we said, are any of us going to quit on them? Maybe on Facebook. We don't own them. We don't own Meta, but many of the others we're all addicted to. And corporations are addicted to, and there aren't a lot of pathways around right now. So there's an enormous earnings pool there that's quite strong and robust. So those are reasons to, I guess, have faith in the future, if you will. And so you can take it from a probability standpoint. What's happened over time is you have about a 70% chance. And when you're in that 30% zone, either on days, months, or years, hopefully the history of Tradex will tell you to hang on. And we're going to do our best as a combined group with your board and management team to try to be true to the touchstones that has built this comprehensive pool of equities for you over time. And your management team and our firm are trying to always do it at a low cost and ensure that we're trying to capitalize on owning companies that would make sure you'd all sleep well at night owning, and companies that are ultimately going to be the kinds of companies, if we could all own in entirety, we would want to. So with that, I'll open it up to questions. And thank you. Yes, please.
I just have a question about mining. We're going into electric cars and batteries and there's a need for precious metals to go into these batteries. And a lot of it comes from Congo and Africa. And we do have some of that precious, we do have those precious metals in Canada. But our government hasn't actually been putting in the funds to go and procure them. Do you think we'll be seeing any of that in the future?
So it's a great question. There's a few parts to it, maybe,
Andrew,
which is.
Repeat again?
Oh, repeat it. So just thinking. So the question was just thinking about the future with all the demand for electric vehicles and just the the transition from fossil fuel-based economy and a number of different materials components that are required to make that possible and an intensification of the usage. And so there are a number of different materials, and so the ones that come to mind, so copper is very important to the electrical grid. Thankfully, we do have some good copper companies, but it's becoming very challenging, and in some areas of the world because of the geographic challenges. But here in your portfolio, tech is an important part of the portfolio because it has a good copper exposure. One of the other areas, interestingly, has become uranium. uranium is overweight for Canadian component of the portfolio through Cameco. Cameco was a company that really underperformed for quite a long time through both poor execution and the fact uranium prices were not coming to life. Uranium prices, if you look them up after, or anytime you wish, you'll see they've really come to life because there's so much demand for electricity now. And the thinking is there's been development of miniature nuclear power plants. The thinking is that one of the only ways we can be effective with renewables is really to also engage in nuclear. So that is, whether or not we do that in North America, it's happening in other parts of the world. So there's more demand for uranium. And then I think when you're saying precious, perhaps the word we hear around our industry is rare materials, rare earths, I should say. And you're quite right. We're having that conversation over dinner. And actually Phil, I think is the expert on this, but was highlighting. So I'm gonna, this is all up to Phil's credit, but I certainly am quite aware. I've got friends in the rare earth industry. We were talking about the fact that it's not only where the rare earths are located, but is in very challenging geographies, politically and all kinds of different factors. But it's also the refining capacity is very specialized in really a couple of places, one of them being within China. And so this is a great challenge. I think it's something like Phil my recollection is about 85% of the world's rare earths are really coming from China, refined in China or in jurisdictions that are highly influenced by China. So your point on Africa and some of these places versus Canada, our hope too, and one of the things that Phil was pointing out is that in Biden's latest bill, there was some money put aside to ultimately try to promote that kind of development in Canada. So rare earths are these very unique. Honestly, it sounds like a Star Trek episode when you read the names of these rare earths. It's things you haven't really come across, but they're incredibly important to being able to make a lot of key electronic processes happen, and some of the things that we take for granted with silicon chips as well. So, a short way, a longer way of saying there's a lot to that. I certainly don't know on the policy side. Phil's more of an expert there, but help may be coming from the United States to help push us along. You're right. You're right. We've got to have our own sources. Yes?
A number of analysts are concerned by the extreme U.S. debt levels and are concerned about the possibility of collapse of the U.S. dollar. Comment?
It's been talked about most of my lifetime, I think, and it is a concern. I think it's a shared concern. I don't think as a society we're thinking about debt correctly in any developed economy. Japan's debt levels are highest as far as I can recall amongst the developed world. We've got a much bigger problem here than we think we do. Provincial debt never gets tallied up. When you look at debt to GDP levels in Canada, they're really looking at the federal. And the federal levels have exploded. And but the provincial is left. Most of the world doesn't recognize there's actually debt held in our provinces. This province is about $500 billion. So we've got a serious structural issue here. The United States, no question, has a deficit that's very concerning and a growing debt problem, and the numbers are staggering. The distinction with the United States that the rest of us don't benefit from is they happen to also be by far the richest nation in the world. So their net worth of their households, we're talking about this today, but mostly this is never carried in anything you read, but the net worth of households has gone from about $65 trillion to in the order of magnitude of about $250 trillion just since the credit crisis. So that's, just sort of think about that for a second. That's absolutely enormous growth. We haven't seen that anywhere else on Earth. So thankfully, their net worth is actually growing as a nation. And so that's that's one of the things you want to have in the background. There's nowhere else on earth where that's happening. So the production, all we're seeing here on the earnings side, the growth of the market capitalization of the companies, there is a richness in America on the corporate side and household side that's not so reflected in the conversation we hear about the government. The rest of us don't have that advantage. So one of the challenges then when you look at the currency, go back to, really the question is you say, well, what does everybody want right now? And most of those things are coming from US companies. So think about most of the products. We do refine things up here. We do produce oil, we do produce a number of things, but ultimately they often come back to us from a US company. So the components we pull out of the ground that go into steel, and they get shipped right back here from Team Japan or Team USA, right? And you can go through it in so many different areas. So we're all demanding, products that ultimately require us to buy US dollars. The investment we're doing in your fund or around the world, when people are looking at global diversification, most of what they can buy globally in size is in the United States. So there is an ongoing demand for that currency is what I'm trying to highlight, and some more resilience than when we just look at the government alone. So if you assume the US could do something about taxes, they have a lot more room to run than we do here. Right now we're scaring people out of the country. And I know that to be, I know of small firms with, literally this many people in it that have been able to arrange for billions of dollars to flow out of this country in last year alone. So we are scaring money out of the country because we don't have a lot of room and we're not competitive. But the United States has a lot of room on the tax side. So I don't have the answer other than to say to you that it's a lot stronger under the hood than it looks when we just look at the government. Yes?
From this is the opposite side to the previous question on energy and earth metals, and that's the current energy situation with oil, natural gas, and coal still. And certainly on the oil and gas side, there's probably more proven probable reserves by far and can never be utilized out of the ground if one takes the necessity of limiting carbon emissions. So there'll come a time when companies may have huge assets in terms of material buried in the ground, but they're lost. They're never going to be able to utilize them in the current situation. And in the short term, the returns from some of those companies are great, but even longer term, they're, I wonder if you react to that.
Sure, but first of all, thanks for these are great questions. I know you're very well informed audience. So, and by no means, again, do we have a perfect perception of what will happen with these things. But what I can give you a flavor for is, number one, I agree that there is a risk of trapped resources. Number two, for everybody to understand, like, what's your exposure in your portfolio today to energy? It's running around 12%. And so that global composition, is diversifying you from the kind of exposure you would otherwise have if this was just a Canadian portfolio. If it was just a Canadian portfolio, it would be composed of about 20% energy. Now, within our 12, about 8 is in the extraction area, okay? And so less than a tenth is in that area. And then where we're focused is in the companies that are quite frankly trying to be very responsible towards getting as carbon neutral as they can. And we can all have various degrees of cynicism about how neutral is carbon neutral, because these are great challenges of our day. There's no question about it. As a society, we're trying to grapple with it. But we are investing primarily in companies that we think are doing their best to steward towards that. Those same companies are not being rewarded to the same degree they used to be for exploration in the environment we're in. So they're also conscious of what you're saying, and they're trying to utilize their proven resources today to generate a lot of free cash flow. As they're doing that, they're buying back stock and they're increasing dividends. And they're doing that at a very rapid pace. Synovus, for example, today you may have noticed, I think it was today, it was yesterday, they were reporting earnings. They're getting very close to having $4 billion in debt. They were one of the most indebted of the big integrated oil companies. They're getting very close to being on track with a target where they'll start to take 100% of their free cash flow, just put it into buying back stock and paying dividends. So there has been a very strong movement towards, essentially decreasing the number of shares outstanding and returning capital to shareholders, as opposed to sticking more money in the ground to find more energy. Now, if you're putting all of that aside, the part we aren't dealing with successfully as a world is that we are constantly growing our use of fossil fuels. So if you look at oil has continued to go up at the rate of global GDP as long as I've been, in my career. It's unfortunately so far unstoppable, despite all of the things we do. And so for these companies, they would argue, if they were here today, that at the end of the day, if we keep disincenting them from finding more oil, there will be a supply squeeze, because we're all using it. It doesn't matter whether it's in your athletic clothes or what's going into your car. Oil's in every plastic we touch, this bottle right here. So it's pervasive, and that's the greatest challenge we're having. We've moved into the zone of 102 to 105 million barrels a day as a globe. So it's a great challenge. Anyway, I hope that helps. There will be potentially trapped resources if we do really move on with renewables. Yeah.
Thank you very much, Andrew Dill, for that interesting presentation. And again, if anyone else has questions, they'll be available to answer questions at the end of our evening. I shall now ask the acting secretary to table proof of service of the notice of meeting.
Yes, I, Phillips, acting corporate secretary, Tradex Equity Fund Limited, hereby certify that a copy of the management proxy circular of Tradex Equity Fund Limited, dated the 27th day of March 2024, filed with the provincial and territorial securities administrators, was sent to each director, each shareholder entitled to notice of the meeting to which the circular relates, and to the auditors of the corporation.
Thank you. Proof of service of the notice calling the meeting has been duly filed, and I direct a copy of the notice with proof of service to be kept by the secretary with the records of this meeting. I am advised that there is a quorum present and direct that the scrutineer's report on attendance be annexed to the minutes of the meeting. I now declare that the meeting is regularly called and properly constituted for the transaction of business. A copy of the financial statements of the corporation for the year ended December 31st, 2023, consisting of statements of financial position, statements of comprehensive income, statements of changes in net assets attributable to holders of redeemable shares, statements of cash flows and schedule of investment portfolio, together with the notes thereto, have been made available and delivered to each of the shareholders requesting a copy. Copies of the report of the auditors on the financial statements are available for inspection at this meeting. The Tradex team strives to focus on providing the best advice for our clients. I would like to take this opportunity to recognize and thank our CEO, Blair, and his team for their tremendous efforts in continuing to deliver results for our unit holders. They have navigated through the effects of the pandemic to serve our customers with dedication and care. Strong governance is the top priority of our board of directors, and I would also like to thank my fellow directors for their wise counsel and commitment to Tradex. And of course, thank you to the Tradex members for the confidence and trust that you place in us. I would now like to ask Blair to make a few remarks.
Thank you, Gabriel. Good evening, members and guests. Portfolio management team, I welcome you to the 64th year of Tradex. Our portfolio management teams have outlined market conditions and their actions to ensure long-term success for our members within their specific mandates. As markets recovered, the success of our portfolio managers, along with our existing and new members continuing to entrust more of your investments through Tradex, have led us to reach a new record in assets held over $473 million at the end of March. As a reminder, Tradex operates on a not-for-profit basis, whereby the excess revenue from our own funds and other investments purchased through us, after deducting the operating expenses, regulatory costs, and the salaries of our staff, are rebated to the three funds at the end of each year. Over the last 5 years, we have rebated over $2.7 million. The growth in our membership and the consolidation of your investments under us directly contribute to these rebates, lowering costs for all members. The individual also saves with a review of recent portfolio reallocations through Tradex, showing an average savings of 31% in cost reduction. Subsequent to the bear market of 2022, as we pass the 4th anniversary from the market lows of March 23rd, you can see that the equity fund has risen over 100%, the bond over 20%, and the global almost 120%. Similarly, from the more recent market lows of October 2022, we're up 26, 12, and 42. We believe you've been well served by our management teams here tonight, and we wish to thank them. For the longer term perspective, Tradex Equity was established in 1960 in part to allow our Canadian diplomats to sell their home, go on posting overseas, and come back and buy a new home in Ottawa. In 1960, the average house price in Ottawa was $16,038. At the end of 2023, the average house price had risen to a whopping $632,000. However, if you put that $16,000 in Tradex Equity Fund, at the end of December, you had over $4.3 million. I would say we're accomplishing our task. In last year's quadrennial member survey, there was sufficient interest indicated in attending an estate planning seminar hosted by Tradex. Our inaugural in-person session was held on April 17th, and there was a sellout crowd registered for the event. All indications from those in attendance, they found the experience rewarding, and so we plan to schedule additional member seminars in the future. In addition to support our mission of providing professional financial advice to public servants and their families, and also to grow our membership, we are continuing to work in partnership with the federal retirees, offering pre-retirement courses for federal public servants, and members are welcome to sign up for one of the upcoming pre-retirement courses if it's of interest. Okay. It may even be of value if you're post-retirement. Last year I shared some of the preliminary results from our survey, and I just wish to confirm that the final numbers are in. The members report 91% satisfaction with the service from Tradex. The best of the big 5 banks is at 61%. And from our advisor team, our advice was rated 66% very satisfied against an industry number of 20% completely satisfied. The team appreciates the affirmation that our efforts are recognized, and we trust it gives members confidence we will continue to provide service that leads the industry for you, your families, and anyone you refer to us. Research continues to demonstrate the significant impact on wealth that working with an advisor can provide. And we encourage you to benefit from working with our team's advice for yourselves and your families. Tradex continues to adapt to the many different financial needs of our members, offering a broad range of services as listed here. If you've not already reviewed all that we can offer with one of our advisors, or you see something that may be of interest, please do not hesitate to contact us. We actually have people that answer the phone. I know it's rare these days. This year's federal budget has created a couple new planning opportunities, I'll just point out, especially around capital gains for anyone who happens to own a corporation or has a trust or as a second home or cottage, while the tax-assisted opportunities to help individuals join the Canadian housing market continue to expand. There's even an incremental tax deduction opportunity for our members who are on foreign postings. Our advisory team would be happy to assist you and yours in maximizing these opportunities. In our continuing efforts to attract more members, we continue to seek and participate in partnerships and sponsorship arrangements with other organizations that are supporting past and public servants. We are preferred partners of the National Association of Federal Retirees, and we're participating in the awards partnership with Applaud, the People in Public Service, which is for our public servants generally. Tradex was built on the strength of our membership, relying principally on the word of mouth, you to alert your family members, present and former co-workers, and eligible acquaintances to the opportunity to become a member of Tradex. To facilitate the process, this year we're using referral forms that are celebrating the 25th anniversary of the Tradex Global Equity Fund. We would truly believe you will be doing those you refer a great service. We continue to utilize industry-leading service providers for our Tradex funds, with the RBC Investor Services, our custodian and record keeper, our auditors, PricewaterhouseCoopers, and our lawyers, Borden, Lanier, and Gervais. And I'd also like to recognize your volunteer investor representatives who participate on the committees overseeing each of the funds on your behalf. We are seeking a new volunteer. You'll hear shortly from one of your representatives, Brian Askett, on the opportunity that presents itself to you. Also here this evening, we have Dina Palamides, who is the investor rep on the bond fund, and Nicholas Todd, who is the investor rep on the Global Equity Fund. We also like to recognize the lowest cost independent review committee in Canada, chaired by Mr. Michael Mace, and with Robert Todd, and I don't think Roger Leclerc is in the audience this evening. Our Tradex team remains focused on serving you better while meeting the increasing industry demands. And on behalf of the team, I wish to thank you all for attending, and we have a gift as you depart. I will now pass it back to Karen to introduce Brian.
I'd now like to ask Brian Askett to say a few words. As Blair mentioned, Brian is a volunteer representative on our various fund committees and has been in that role for 21 years. Brian.
Thank you. Yes, good evening. Some of you know me personally, and I think you've seen me get up for many years. The last 25 years I've been on investor rep for you, 21 of those years. I've been on all three committees, and it's extremely interesting. Each one are quite different, but I enjoyed it all. But it's time now for me to withdraw and let somebody else step in with new lives. I can say it's been very enjoyable. It's always a pleasure working with the new members, the executive, and I've gotten to know many of them over the years. It doesn't take a lot of work. You only meet 4 times. You do get a stipend, and there are some benefits. And if you're keen on this sort of type of thing, I'd certainly ask you to contact Blair for further details. Thanks, Karen.
Thank you, Brian. It is now in order to proceed with the election of directors. 10 nominees for election are named in the proxy circular. In accordance with governance practices for Canadian public corporations, the proxy provides shareholders with the option of voting for or against each nominee individually. However, to ensure this meeting is concluded in a timely fashion, and as management has received proxies representing 19% of the shares, we will ask for a nomination of all 10 individuals and record the majority vote as to each individual. Please ensure that if you wish to vote contrary to the majority for an individual, you advise the scrutineers and your vote will be recorded in the formal results of this meeting. I would now like to take this opportunity to introduce each of these people to you, and if the directors would please stand as I call your name. Bob Baldwin, Phil Charco, Lenny Collette, Blair Cooper, Blake Johnson, David Plunkett, and Hanny Toxopeus. 2 of our directors are not with us tonight, Tom McDonald and Arit Weiser. I would now ask for Tono Unu's motion.
I nominate the 10 persons as individually named: Bob Baldwin, Phil Charco, Lenny Collette, Blair Cooper, Blake Johnson, Tom McDonald, David Plunkett, Hanny Toxopeus, Arit Weiser, Karen Zabel.
If I could have a second on the motion?
I second nomination, 10 nominations. We should carry the nominations.
Are there further nominations? All those in favor of the motion, please signify by raising your hand. I declare those nominated to be fully elected directors of the company to hold office until the next annual election of directors or until successors are elected, subject to the provisions of the company bylaws. The next item of business now is the appointment of auditors, and I believe Phil Charco has a resolution in this connection.
I move that PricewaterhouseCoopers be hereby appointed auditors of the corporation until the next annual meeting or until a successor is appointed, and that their remuneration as such be fixed by the board of directors.
I could have a second?
I second the motion.
Thank you, Bob. All those in favor, please signify by raising your hand. Anyone contrary? Thank you very much. The motion is carried. Now for other business. Is there any further business to be brought before the meeting? Yes.
Yeah. I have 2 questions for the chair and for the president. Blair, I want to say how impressed I am with your leadership and the team that you lead. I mean, it's just extraordinary. I get a lot of benefit out of it. And the performance of those funds as well. I think those funds are just unique, and they try and replicate that with an ETF. You need about 10 of them, and I'll try. And it's quite a little rebalancing the portfolio. But there's no denying that redemptions, it's an industry-wide thing. Redemptions are exceeding contributions, as they are with all of these 3 funds. And I'd like to know whether, no doubt you're aware of it, but what kind of thought or strategy, or as an industry or as Tradex, can we do to stem this, to educate further, to succeed and draw others in?
Thank you. And so the basic question is, there are net redemptions in the industry and the Tradex funds, and what do we do about it? So first, I would have to say, While Tradex's mission is to help all of those who work with us to grow their wealth over time, we refuse you access to spend. And amongst our membership and amongst the industry's investors, there is a higher proportion that are in what's known as the decumulation stage of life than there are in the accumulation stage of life. What that results in is that the net being put into investments by the younger generation that have so many better things to do with their money than invest is not the same as the amount that is having come out due to RIF requirements or children needing to buy a house that the older generations are helping. Right? Okay? So that is is the one piece of it. Net redemptions actually, and somewhat of a surprise to me, net redemptions in the 60s and 70s from the Tradex Equity Fund were significantly higher than they are now, in dollar terms. So adjust that for inflation. But that aside, what we rely on to a great extent is the ability of our portfolio managers to deliver a return that is above those net redemptions. As long as that happens, the funds are just fine. And I'm sure you're aware, the mutual fund industry has been called dead or dying for a long, long time. And it's growing at a significant rate. But yes, there are net redemptions. As long as we can find investments that offset that, or are more than that, then it is a manageable situation and will continue for long after I'm under the roof.
Thanks very much. I had one for Karen, if I might. Last year at this time, I pointed something out about what I thought was a little bit of a surprising few number of units held by certain directors. And you acknowledged that and were kind enough to what seems to be addressed. And I noticed that in your letter, and I want to commend you and the board for taking action on something that was either real or perceived. So I'm really pleased that you folks listened, and I may have had a point. So thank you very much. But that doesn't mean I'm out of concerns, because your letter included something that kind of scared me. And it was about the number of committees that you're about to undertake. And I think it said 7, and then I saw that they're looking for a number 8, which is the CEO succession, which I guess is there a rumor mill on that? But I'd really like to know about this start of 7 or 8 committees that you're putting in place, and what was behind it, and how pressing is it, and what was there anything before that?
Well, I think what you'll find is, if you looked at other companies and other boards, that certain committees are standard for board governance. One, of course, would be the audit committee, and one would certainly be the governance committee. So those are standard committees that any board would have, regardless of the type of industry you're in. Now, in our case, we have additional committees because we do have the 3 fund committees. The equity fund, the bond fund, and the global fund. So that adds 3 committees. We have a fund oversight committee, which resulted because we have third-party funds, as I'm sure most of you know, that we sell. And so really, although I agree, I mean, I know we come from government, many of us, and maybe we're a bit bureaucratic, but we certainly don't want to sort of keep adding on committees, but unfortunately, the regulations are such that we do have responsibility for oversight for all these funds and all these areas that we're managing and governing. And so most of these committees, I believe, do carry out an important role in ensuring that that the board and the organization is in fact carrying out its mandate appropriately. So we recognize, yes, you're right, we do have a lot of committees. We've had other committees in the past that we've had for 2 or 3 years to deal with a particular issue, and then when that issue's been resolved, we've dissolved the committee, so we are conscious of that. You know, the unfortunate thing is it does demand more time of the directors, as you can appreciate. But we believe as a board that it really is necessary for us to carry out our role.
Well, I like it, but I got the impression they were new, so I thought.
No, they're not new, no.
Okay.
And I just want to add something, thank you for your comment. You know, we discussed your question at the board, and we decided that, you know, like many things, we have all this information in our heads, but it hasn't really been shared with our unit holders, and hence the letter that I wrote, which is now posted on the website, which does explain at a fairly high level what the role of the board is and how we carry it out. But to your particular question about the directors having, you know, skin in the game, as they say, to my knowledge, you know, you would see in the fund report, the Tradex Equity Fund report, the number of units of Tradex Equity Fund that directors, each of us hold. And you'll see that number varies. You might wonder, well, you know, they have a lot and they have little. But we also own, are able to also own units in the other two funds. So, and that's obviously not been made aware. We've not been made aware of that. So when you see those units that we hold, and you might think, well, you know, and I know I'm one of the ones who's probably on the low end of that list. We also hold the units in some of the other funds as well.
Thank you.
Very well. All right, so if there is no further business, then I will ask Blake Johnson for his resolution to bring this meeting to an end.
Thank you, Madam Chair. I move that the meeting do now terminate.
David, if you could second.
I second the motion.
All those in favor, please signify by raising your hand.